Hi, my name is Richard C. Cook. I'm the author of this new book, We Hold These Truths, The Hope of Monetary Reform. Welcome to part 2 of a 6-part video entitled, Credit as a Public Utility, the Solution to the Economic Crisis. The title of part 2 is, The Federal Reserve System, The Bankers Take Over. Let's return to our survey of U.S. financial history. As you recall, we were talking in part 1 about how, during the Civil War, the U.S. government printed and spent into circulation the paper money known as the greenbacks. This was revolutionary because in European warfare, the governments always would end up deeply in debt to the bankers. This is how the system works. It is a remarkable fact of history that this did not happen to the United States during the Civil War. As if in response to President Abraham Lincoln's wish for the people's government to control its own currency, the London Times wrote in 1865, "If this mischievous financial policy, which had its origin in North America, shall become a fixture, then that government will furnish its own money without cost. It will pay off debts and be without debt. It will have all the money necessary to carry on its commerce. It will become prosperous without precedent in the history of the world. The brains and wealth of all countries will go to North America. That country must be destroyed, or it will destroy every monarchy on the globe." What an amazing statement. It shows how powerful the greenbacks were in freeing the United States government from the power of the banks. We know that Great Britain, home of the Bank of England, sympathized with the South in the Civil War. President Lincoln was assassinated on April 14, 1865, by John Wilkes Booth, who had recently paid a visit to the British-controlled city of Montreal. There, Booth received money from Confederate agents, which financed his conspiracy. Otto von Bismarck, the great Chancellor of Germany, was reported to have said in 1876, 12 years after Lincoln was assassinated, "The division of the United States into federations of equal force was decided long before the Civil War by the high financial powers of Europe. These bankers were afraid that the U.S., if they remained as one bloc and as one nation, would attain economic and financial independence, which would upset their financial domination over the world. By the victory of the North in the Civil War, the Union was preserved. For now, the financial powers of Europe were thwarted, but they were to have their revenge." Another president who understood the necessity of having the people's representative government, not the bankers, in control of the money supply was James Garfield, elected in 1880, and also killed by an assassin's bullet in 1881. Garfield was a Republican in the mold of Lincoln. Just before his death, Garfield said, "Whosoever controls the volume of money in any country is absolute master of all industry and commerce. And when you realize that the entire system is very easily controlled, one way or another, by a few powerful men at the top, you will not have to be told how periods of inflation and depression originate." Garfield knew, as did others at the time, that inflation and deflation, booms and busts, were monetary phenomena. The banks benefit when prices go up because their interest earnings soar. When prices fall and people and businesses go bankrupt, the banks and the rich buy up their assets for pennies on the dollar. But by controlling the currency through a system like the greenbacks, the government could moderate financial crises. So after the Civil War, the bankers tried to get Congress to retire the greenback currency. Congress, however, knew the greenbacks were the best money the country ever had. They were not inflationary. They allowed the government to pay a portion of its wartime expenditures without debt, and they were widely acknowledged as having saved the Union. So the greenbacks remained in circulation, with the Supreme Court upholding their constitutionality. As late as the year 1900, the greenbacks still made up close to a third of the nation's circulating currency. During the latter part of the 19th century, the U.S. had gone through the most explosive period of economic growth in human history, again, without a central bank. But in spite of the greenbacks, the banks were still politically powerful and managed to gain a foothold during the Civil War. Under the National Banking Acts of 1863 and 1864, a new system of national banks was set up, whereby their lending would be capitalized by Treasury bonds purchased from the government. It was a similar system to the first and second banks of the United States, though not yet organized into a single central bank. From that point on, the federal government had to go into debt to the banks so the banks could make loans to the public. It's the way the system was set up. During the rest of the 19th century, the power of the banks grew. The number of their banknotes increased along with the national debt, gradually replacing the greenbacks, whose quantity had been fixed by legislation. Not only did the banks lend money to businesses for commerce, they also wrote mortgages on real estate, lent to farmers for the expenses of planting and harvesting, and began to acquire controlling interests in railroads and industry, such as the steel industry. The bankers were also able to reduce the proportion of debt-free money available for circulation by getting Congress to limit the amount of silver the government could purchase, leaving gold, which was scarcer, as the currency's primary backing. From time to time, as Garfield had warned, the bankers also produced what were then called panics, by limiting credit, causing thousands of farms and businesses to fall into their hands through foreclosures and bankruptcies. The worst panics were in 1873 and 1893. Through the panics, the banks were becoming the most powerful institutions in the nation, certainly more powerful than the federal, state, and local governments. During the latter part of the 19th century, the battle over the monetary system raged. The Greenback Party was formed to protect and expand the greenback monetary system. Expansion of the money supply was the primary thrust of the Populist Party, which also formed during this period. Matters came to a head in the presidential campaign of 1896, when the Populists took over the Democratic Party and ran William Jennings Bryan against the Republican Party's William McKinley. Bryan was a pro-silver candidate who declared that mankind should not be crucified on a cross of gold. Bryan was clear that the government, not the bankers, should control the money supply. He declared, "We say in our platform we believe that the right to coin and issue money is a function of government." Bryan also said, "The money power preys upon the nation in times of peace and conspires against it in times of adversity. It is more despotic than monarchy, more insolent than autocracy, more selfish than bureaucracy." But the bankers and the industrialists poured money into McKinley's campaign, who won a narrow victory. From that point on in our history, the Republicans were the party of big business and big finance. The panics that resulted from monetary contractions continued into the 20th century. One took place in 1907 through the actions of the New York Money Trust, whose head was J.P. Morgan. Morgan printed $200 million of his own private money to bail out the system, appearing to have saved the day. In 1913, claiming they were bringing stability to the banking system, the financiers, including the Morgan interests, plus a cartel of British and European bankers, as well as various American industrial monopolists in league with the banks, all worked together to get Congress to pass the Federal Reserve Act. The Federal Reserve System, set up by the Act, is a privately controlled central bank, like the Bank of England and the first and second banks of the United States. It appears on the surface to be a government institution because it issues currency in the form of Federal Reserve notes, buys and sells Treasury bonds, and holds U.S. Treasury funds on deposit. It thus acts as what is called the fiscal agent of the Treasury. Since 1935, the chairman of the Federal Reserve has been appointed by the President of the United States, but the banks of the Federal Reserve, including the 12 regional banks around the country, are owned by member banks, which are owned in turn by private interests. And the policies of the Federal Reserve are directed to this day by the leaders of the financial elite, not elected public officials. Charles Lindbergh Sr., father of the future aviator, was a member of Congress in 1913 when the Federal Reserve Act was passed. Lindbergh said, "The financial system has been turned over to the Federal Reserve Board. That board administers the finance system by authority of a purely profiteering group. The system is private, conducted for the sole purpose of obtaining the greatest possible profits from the use of other people's money." Lindbergh called the Federal Reserve Act the worst legislative crime of the ages. Also in 1913, the 16th Amendment to the Constitution was passed, authorizing the income tax, whose main purpose was to pay the interest on the national debt, which the banking system used as the basis for its lending to the public. President Woodrow Wilson signed the Federal Reserve Act into law. Later he wrote, "A great industrial nation is controlled by its system of credit. Our system of credit is privately concentrated. The growth of the nation, therefore, and all our activities are in the hands of a few men. We have come to be one of the worst ruled, one of the most completely controlled and dominated governments in the civilized world. No longer a government by free opinion, no longer a government by conviction and the vote of the majority, but a government by the opinion and the duress of small groups of dominant men." Why then did Wilson sign the act? In his memoirs, President Herbert Hoover, earlier a witness to the legislative process, recorded the promises bank lobbyists had made to Congress and Wilson to get them to approve the Federal Reserve Act. Here is what they were told. "We shall have no more financial panics. Panics are impossible. Businessmen can now proceed in confidence that they will no longer put their property in peril. Now the businessman may work out his destiny without living in terror of panic and hard times. Panics in the future are unthinkable. Never again can panic come to the American people." Ever since 1913, it's been the private banking system, including the Federal Reserve, through which an oligarchy of the rich and powerful has ruled the United States, its people, its economy, and its institutions. The panics have continued. We are in one today. Of course, not everyone has gone along with the oligarchy 100% of the time. A notable exception was President Franklin D. Roosevelt, whom the oligarchy, centered largely on Wall Street in New York, called a traitor to his class. Roosevelt was elected in 1932 during the Great Depression. The Bank of England, working with the Federal Reserve, brought on the Depression by creating the investment bubble of the Roaring Twenties, then using interest rate policies to suddenly shrink the amount of money available for speculation in the New York stock market. The stock market crashed in 1929 and did so again in 1932 when the Federal Reserve shipped much of its gold stock to Great Britain. Lacking sufficient gold backing, the U.S. money supply suddenly shrank again, though the economy had begun to recover from the 1929 crash. These events showed the tremendous power the Federal Reserve and the banking system hold simply by turning the money faucet on and off whenever they care to. But President Roosevelt brought the nation back during the New Deal by creating jobs and using agencies of the federal government to provide low-cost credit for businesses, farming, and family housing. Under Roosevelt, the Federal Reserve worked cooperatively with the government to issue enough currency for the nation's economy to start growing again. But by the 1950s, Wall Street was again asserting its control. Bank interest rates began to be raised after the U.S. Treasury agreed in 1951 to reverse the policies of the New Deal and allow the Federal Reserve Act to act independently as it had leading up to the Great Depression. In the 1960s, President John F. Kennedy had grave reservations about the growing power of Wall Street over the U.S. economy, but was assassinated in 1963. The policies of the New Deal, which had used public control of credit to build the greatest industrial democracy ever seen, were fading away by the 1960s. By the 1970s, the financiers had become dominant again and started taking over the economy through a series of measures that eventually led us to the disaster we are seeing today and the crash of 2008-2009. The United States has been a nation dominated by the financial elite, who are in charge not only of the banking system, but of all corporate America. The crash the financiers have led us into today could lead to the end of America as we have known it. Later, we will examine the proposals of President Barack Obama and his administration. While there are several measures to aid working Americans, much more needs to be done. The most important thing is for control of the monetary system to be taken away from the financial oligarchy once and for all. This control should be placed directly with our representative government and managed for the benefit of the people. But first, we will use the next session of this 6-part video to take a look at the economic history of the last 40 years and see how the crash came about. Thank you for watching.